Hi students. Today we're going to talk something exciting. Beta. Um, when you use the CAPM model to estimate the cost of equity, one important variable is beta. For public companies, betas are widely available, for example, through some financial publications such as Value Line or Yahoo Finance. But if your subject company is a private firm or a projecting company, is it a bias to use a public company's beta directly? Or if it's a project in the developing countries, it will be a bias too? So today we will discuss these two special situations one by one. Because a specific project is not represented by a public traded security, we typically can't estimate a project's beta directly, but we can adjust for differences between a specific project's beta and the equity beta of a publicly traded firm that is engaged in a business similar and the risk similar to the project under consideration. So, in other words, we begin with the beta of a company or group of companies that are purely engaged in a business similar to that of the project and are therefore comparable to the project. So, this is why we call it pure play method. We can use this pure play method to calculate a private company or a project's cost of capital following the steps below. So the first step is that we need to find a public traded firm and calculate its asset beta. So after we identify the beta of a similar public traded firm, we need to adjust this company's beta for company's leverage. We call it unlevered. Unlevered. The reason of doing this is the beta of a firm is a function not only of the business risk of the projects, but also of its financial structure. So use the formula here to get the asset beta for a publicly traded firm. So remember that the D ratio, the debt to equity ratio here in this formula is the comparable company's D ratio. The comparable company is the public traded companies D ratio, and the tax rate here is also the comparable companies, the public companies' marginal tax rate. Okay, since our target is to find our project's beta or to estimate a private company's beta, so after eliminating the finance structure's effect from the comparable firm, we need to relever it based on subject company's financial structure. So from the formula listed here, you can find we multiply the D ratio with the asset beta. Also remember that D ratio here that we used is the subject company's D ratio, and the marginal tax rate is also subject company's marginal tax rate. Now things becomes easy. We can use the equity beta we calculate from step 2 to calculate the cost of the equity following CAPM model. As stated here, cost of equity equals risk-free rate plus equity beta times the differences between the market rate of return and the risk-free return. If you want to further calculate the weighted average rate of cost of capital, you can follow the formula listed here to do it. So weighted average of cost of capital equals the weight of the equity times the cost of equity plus the weight of debt times the after tax the cost of debt. Kind of headache after all these formulas? It's normal. Now let's apply these previous procedures to work on an example together. Sugar Inc. is considered a project in the candy business. It has a DE ratio, debt to equity ratio of 2, a marginal tax rate of 40%, and its debt currently has a rate of return of 14%. Mars Candy, a public traded firm that operates only in the candy business, has a DE ratio of 1.5, a marginal tax rate of 30%, and equity beta of 0.9. The risk-free rate is 5%, and expected return on a market portfolio is 12%. The question asks you to calculate Mars company's asset beta, the project's equity beta, of course, which refers to the Sugar Inc., and appropriate WACC to use in evaluating the project. Okay, after reading the questions, let me ask you, which company is our subject company? Yes, Sugar Company. And which company is our comparator company? Yes, Mars Candy is our comparable company. Okay, so now let's follow the steps we learned to try to figure out what is Mars asset beta is. As we said, the public traded firm in this example is Mars Candy, right? And it is purely operates in candy business. So we can use the formula we learned previously to calculate Mars asset beta. The first step is to unlever it, right? Okay, so we apply the numbers. So the 0.9 is the beta equity of the Mars company, and the 30% is the tax rate of the Mars company, and 1.5 is Mars DE ratio. So, and we apply all this number in this formula, and we can get the beta asset is 0.439. So the second step, or the second question they ask is ask you to calculate the equity beta for the project in Sugar Inc. So this is the formula we learned to calculate the beta equity. The beta asset is the one that we just get from the step 1, right? Okay, it is a beta asset because it is comparable company, so we just use a Mars beta asset to apply to this formula to try to calculate the sugar's equity beta. Just remember that we know that the tax rate here we need to use the subject company's tax rate, which is 40%, and we need to use subject company, and in this example is Sugar Inc.'s DE ratio is 2, right? And then we can get the beta project is 0.966. Now it's easy to apply all the beta we get and all the numbers that provided in the question, and use the CAPM formula to calculate the cost of equity. So the project's cost of equity equals the risk-free rate provided, which is provided by the question, is 5%, plus the beta equity we just calculated from step 2, and times the differences between the market rate of return and the risk-free rate, and you can get the cost of equity is 11.762%. So the last step, we want to calculate the WACC of the project. The formula stated here, the WACC equals the weight of the equity times the cost of equity plus the weight of the debt times the after-tax rate of the cost rate of return of the debt. So the important thing is that we need to get the weights of the debt and equity, right? But it did not give you the amount of the debt and equity. How could we do that? Well, we can use the DE ratio to calculate the, the weight of the debt and weight of the equity. The D ratio is given as 2, right? For the sugar company, it's giving you the D ratio is 2. So we can give equity a value of 1 and debt a value of 2, like this. So then it is easy, right? So the weight of debt could be the D divided by the combination of D and E, right? And gives you 2/3. And the weight for equity, because we give equity a value of 1, and the combination of D plus E is, or the sum of the D plus E is 2 plus 1 is equals 1. So the weight for the equity is 1/3, right? Now we know, now we have calculated the weight for the equity is 1/3, and weight of the debt is 2/3, and we have calculated the cost of equity from our last step, and here is 11.762%, and tax rate is given in the question as 40%. The cost of debt was given in the question, which is 14%, and we have everything for the formula, so we can get the WACC is 9.52%. Okay, get it? Okay, so the second part, the second situation is that what if that you need to conduct a financial analysis for a developing country. It is quite common for today because of globalization. It's very likely that you need to make analysis for international company, right? But if we use a CAPM to estimate the cost of equity, it might lead to some problems, because the data we obtain here, I mean the United States, does not adequately capture the country risk in the developing countries. So in order to reflect the increased risk associated with investing in a developing country, a country risk premium is added to the market risk premium when we use the CAPM formulas. So a revised CAPM equation is shown in this slide. So compared to the general CAPM formula that we introduced previously, we just add the country risk premium to the market risk premium here. Okay? And if you need to further estimate the country risk premium, you can use this formula on this slide to do it. It kind of don't freak you out. It's not scary as you think. Okay, the conceptual framework of having this formula is like this. So first of all, the general risk of the developing country is reflected in its sovereign yield spread, which refers to the yield differences between the developing country's government bonds and the treasury bonds of the similar maturities. The treasury bonds, as we know, are the US government's issued bonds, right? Okay. The second, the equity risk in a developing country can be reflected by the ratio of volatility between the country's equity market and its government bonds market in terms of developed country's currency. As we know, generally, we can use the standard deviation to measure the volatility of certain assets. So this is the conceptual framework behind this formula. Okay, now let's work on an example together to kind of digest what we learned and to kind of apply what we learned. Okay, for example two, the question is like this. You are estimating the cost of equity for a project starting in Brazil. You have collected the following information. So project beta equals 1.25, expected market return equals 10.4%, risk-free rate is 4.2% and country risk premium equals 5.53%. If it asks you to calculate the cost of equity of a developing country, you need to use the revised CAPM equation to calculate it, right? So the revised CAPM equation is listed here, so we just need to apply these numbers into the equation, right? So numbers are all given here. So the risk-free rate is here 4.2%, and beta equity is, yes, it's our project beta, it's 1.25, and times expected market return is here, and risk-free rate is here, and the country risk premium is given as 5.53%, and you can get the cost of equity of the projects in Brazil is 18.86%. Okay? Once you know the formula and how to apply the numbers, I think it should be very straightforward, right? Okay, last, if you want to further estimate the country risk premium, you need to use this, right? You need this kind of scary formulas to do that. This is questions. So you gather the following information about the capital market in the U.S. and in Zambia. And it was given that the yield on the U.S. 10-year Treasury bond is 4.5%, yield on Zambia 10-year government bond is 10.5%. Looking at that, the maturity is the same. Okay, so and because the maturity is same, it is comparable. And the annualized standard deviation of Zambia's stock index is 35%. Annualized standard deviation of Zambian dollar-denominated government bond is 25%. So first of all, in order to calculate the country risk premium, we need to estimate the sovereign yield spread, which is the differences between the yields of government bonds in the developing country. In this example is, Zambia. The government bonds yield in Zambia is 10.5%, right? Yes. And the treasury bonds of course is the U.S. Treasury bonds, which is 4.5%, is 6%. Okay, so the sovereign yield spread can be calculated like this, and is 6%. And then we need to look for the information of annualized standard deviation of equity index in Zambia, which is 35% here, right? So put 35% here and divide the Zambia dollar denominated government bond. The standard deviation is 25%. And we apply all this number into this formula, and it gives you the country risk premium is 8.4%. Okay, so I believe that based on the formulas, if you can find out the correct numbers and apply to the formulas to the correct place, the calculation should be straightforward. Okay, so this is all for today, and I hope you enjoyed the study. See you next time.